Hi, you're watching BQ Prime. I'm Tamanna Inamdar, and today on the sidelines of the UBS India conference, I have the opportunity to catch the head strategist of UBS India, Sunil Tirumalai, is with me. Sunil, great to have you on, and thank you for taking the time out from what is a busy morning, I'm sure, and sitting down with us. A lot of excitement right now on the Indian equity story. I would dare say most commentators are giddy with excitement. But you have a more sobering and, would I say, balanced view on what's happening right now. Let's start with that.
Thank you, Tamanna, and good afternoon to all your viewers. Yes, I think it's not an excitement that's just recent. I think I would say, the structure and the levels of the market have seen a sea shift post-pandemic, right? I'll can get into some of the reasons behind it, but as things stand, we are a bit cautious, right? So we are, we believe where the valuations are, what the companies are able to deliver in terms of growth for a foreign investor, the kind of opportunities that are available elsewhere outside of India, for instance. Doesn't warrant, being positioned for a very strong rally in the near term, right? So we're actually having an underweight stance on India in our EM ratings universe, I think if I go into some of the reasons behind why I would be a bit cautious. I think the narrative around the Indian economy is on very strong grounds. Right, so we are a sea of normalcy when many other large economies are seeing uncertainty. Our policymakers have managed to keep our macro risks controlled, right? And even from a politics or geopolitics, we seem to be fairly stable. But that's the economy. For me, the market is kind of different, right? If I look at the stocks and the companies in the index, I look at, let's say, the last 5 years of delivered EPS growth and the next 3 years of expected EPS growth, compared to the other rest of Asia, rest of emerging markets. India is pretty much in the middle of the pack, right? So, we've not really hit the ball out of the park in terms of growth delivered by companies, right? Contrary to popular perception, there is a lot of capex happening in India that's primarily government-led. Corporate capex has actually been fairly weak, right? I mean, if you look at corporate capex levels have been flat for the last 12 to 13 years, and nearly a quarter of that these days is driven by one large company. And if I include that one large company and all SOE, all PSUs together, nearly half of the capex today is being done by just these entities. Right? It's very concentrated. It's not growing. So the companies are actually not investing into their own growth. Right, and that for me as a market strategist is an important signal. Are the companies confident of seeing demand in their businesses, and hence are they investing? There are some pockets of capex optimism that is there, but those are sectors which are fairly small. So in this context, right, when we are saying growth is kind of ordinary, right, the valuations are quite expensive, right? So the valuation is where the narrative has actually got pushed in. And in fact, if you actually see the, if I look at India from a global context and look at how foreign flows have behaved over the last 3 years, India has actually probably seen one of the weakest foreign flows performance across emerging markets, right? It's only this year we've seen some positive flows. The preceding 2 years have been fairly weak. But in spite of that, Indian market did well, and the reason behind it is basically the domestic money, right? So that's a completely different area of debate that we can get into. But from a global perspective for a foreign investor, I think India looks fairly expensive for not so extraordinary growth.
Are the Q2 numbers that we've seen, and I'm asking you this because the majority of them, at least the large caps, the Nifty companies, have already delivered their numbers. Are they underlining this observation of yours? What is your takeaway from the Q2 numbers so far in terms of performances of companies?
So we've been seeing earnings cuts. So for the Nifty, we've seen earnings cuts through the last 1 month of earnings season, primarily led by financials and IT sectors. Right. I think there is one thing on what's happened to the earnings. So when I say earnings cuts, I'm talking about FY24, FY25 EPS estimates of consensus are being brought down. Right. There is one thing on just the earnings, and the other thing is what you learn from the companies, when they come out on the conference call and start saying, etc. I mean, so it seems like, let's say, in the bank space, we may be nearing the end of the margin expansion cycle, right? And in some cases, I mean, some pressures are already are being visible, and that matters because for the last 18 months. Nifty EPS was being held up and supported primarily because of bank margin expansion, and that seems to be coming to an end, right? IT services companies, there is uncertainty on demand, right? I mean, you're getting orders, but existing orders are getting downsized or shrunk or whatever. I think if you see beyond these two large sectors, I think. I headed into this earnings season trying to get clarity on whether weak rainfall this year because of El Nino or whatever has had an impact, or are we, is it all behind us? I think it's still mixed, right? I mean, I think even for consumption-focused sectors who depend on, mass segments or rural or bottom of the pyramid, I don't think we're, fully out of the woods yet. So I think if you're in a premium category, kind of a product and a company, I think you're doing fine, but mass segment is still not doing fine. So overall, yeah, I mean, I think it's a mixed result season. Generally, if earnings are getting cut, then that is an indication that things got missed.
Just to take forward from that, in the consumption space, when you speak to a lot of companies, their managements, the narrative and a common refrain is that festive season didn't fall in Q2 this year. It will fall in Q3. It's been delayed, and then you will see a better H2. You will see a better Q3. Do you buy that? Is there that much dependence?
I mean, that's a fact. I mean, we can't debate the fact that...
As in things will dramatically improve because of, say, a month-long or 20-odd days of festive season across different parts of the country.
Which is true. I mean, I think we're not... Which is why just the earnings numbers of September quarter end is not the only thing that you look for. If you talk to a company that reported on Friday, they've seen all of Dasara and Navratri is seen, and a fair amount of Diwali shopping is also known to them, right? So you go by the commentary that they make post earnings closed on the on the earnings call, for example. So yeah, I mean, there is hope. I mean, but we're not sure if I mean, if you look at the data on rural spends, or the fact that employment demand in Narega scheme is actually been going up. If you look at just the sowing season and the fact that August was really bad on rainfall, September we got some rains, October some rains, but since then there's nothing. The upcoming winter crop, it's very important that there is some rain at least, from the yields perspective. I think it's a fairly fragile setup as far as rural consumption and rural sentiment is concerned.
I want to talk a bit about small cap stocks and mid cap stocks. I wouldn't even just say flavor of the season. It's the craze of, say, this calendar year. Since January, the NSE 250 small cap increased some 40%. There was some correction, some pain. Do you think that's over? What is the view that you're forming on this space, which is right now a darling of the Indian investor, especially the retail or the domestic investor?
Right. So I think I'll take this opportunity to talk about a few related things, right? One is about, the domestic money, the household money that's actually coming towards the markets, what that meant for valuations overall, and then valuations for small caps, right? I mean, I mentioned earlier that the outperformance of India over the last 2-3 years is primarily driven by domestic money, and I think there were a few factors behind it, right? I mean, you had savings go up significantly during the pandemic, and then the rates went down very low. I mean, we had SBI, for instance, the largest SOE bank in India, offering you about 4.8, 4.9% 1-year term deposit. Right? That, I mean, people in our generation haven't seen that kind of. So that basically fueled a lot of risk-taking behavior, from households, and of course, with that, the market also did well, and there has been a recent taste of success in terms of your investment, and it's done well, etc. But if you see now, I mean, of course, the bank deposit rates have gone up, and they're more likely to stay higher. That has started having some impact already, right? I mean, when we track, so people generally look at mutual fund flows as an indicator of retail momentum, and in the markets directly they look at volume of retail trade, but we have a mechanism to actually extract the flows of retail activity in the market itself. That's been close to zero this year versus a very big positive number last year, right? So you're actually seeing money directly going into using apps to buy stocks in the market. That's actually subdued quite a bit this year. But what is still happening is money going into the mutual funds, right? And that's where I believe that's what is driving the small cap, rallies that you spoke about. Taking a step back in terms of how valuations in India have actually become, right? So when we do a quantitative exercise trying to see across emerging markets, if I take out the look beyond the fundamentals that can drive valuations for a stock, right? I look beyond the growth rates, the ROEs, the sector from which the company is coming from, etc., and then try to see how much of the valuation of a stock is driven just because it is listed in India versus listed in Brazil versus listed in China, etc., right? And the India premium beyond fundamentals, just because it's a stock in India, is today 80%. It used to be 30% pre-pandemic, and it used to be 20% pre-2014, right? So you would always want to give a premium to India, but I think that's got stretched to a significant extent now. So of course, it's something for all of us to be proud of, right, as Indians. But from a market perspective, I mean, we also need to be conscious of the risks if there is a correction. Now, small caps, I don't think it's fully done yet in terms of the correction. I mean, you still are seeing premium levels or the very low discount levels to large caps, which still suggests there is a lot of richness in that market, and that's something that I would be a bit worried about. I mean, it's a good thing to see there are AMCs which are actually slowing down consciously, putting in barriers for inflows into small cap funds.
Lump sum fund stoppages.
Right. I mean, I think that's a good disciplined practice, but that basically means that there's a lot of money chasing a small part of the market, and that can be a bit worrisome.
Can we go just a little bit sector specific? I know you don't talk about stocks, but what's looking good? For example, realty stocks on a tear. A lot of segments now showing promise of picking up after a long cycle. What's on your radar? What's looking good in a market that you say has pretty big fat valuations right now?
Yeah, so it's a very tough job as a strategist to try and find, and especially because as a team we've also been turning cautious on a few sectors incrementally over the last 5 or 6 months, because stocks have done well and most of the positives seem to be priced in.
May I ask first, what's on your cautious list?
So let me start with that. So from a global perspective, UBS is expecting a recession in the US and kind of flattish growth in China. That generally is not a great setup for commodities sectors, right? So that's one, I think, one clear area where we are kind of cautious. I think we turned a bit cautious on consumption space as a whole, staples and discretionary, but I think between the two staples actually is we would be more positive than discretionary because they have underperformed, and typically what we see is that when rates fall sharply, the staple stocks, especially the ones listed in the large ones, tend to be very rate sensitive. I mean, they're actually seen by the market as growth stocks and not really stable companies, because that's the nature of the business, right? So I think if there is actually a fairly sharp drop in rates globally or in India, staples should come under play. They should start doing well. I think I would say I mentioned about IT services, briefly about how some of the near-term demand trends seem to be, a bit worrisome. I mean, I wouldn't be positive, in the near term over there. So where would I be positive? I mean, I think all said and done, I mean, we are nearing the end of the margin upgrade cycle, which we could start seeing, some margin cuts. Our banks team has written a fairly detailed piece on how retail unsecured loans is something that we need to really keep a close eye on. I mean, they're becoming big, etc. But all said and done, I think banks are one place where valuations, though not cheap, they have generally derated versus the rest of the market from pre-pandemic levels. Right? And I think that's more technical reasons than fundamental reasons. Technical because I told you that there has been a lot of foreign selling in India, and generally disproportionately that sector gets affected whenever that happens, right? And so I think that's one place where there is opportunity. Among the other sectors, that we look at, I think there is fairly good momentum in the industrial space. I mean, that's cap goods and engineering, all the sectors put together. There is momentum because the government is focused on capex. It's primarily government driven. It's not private, capex driven. The stocks have done well. I mean, there have been a few downgrades that we've seen that we've done in that space as well. But I think the near term momentum, notwithstanding elections coming and some deviation of funds, etc. I think it seems okay. I think that's one place also where I would be positive.
Is the elections a big factor that you're watching out for?
So over the last 3 election cycles, I think the importance of elections for the markets has come down. Right, market. So that there's been a lot less uncertainty. When do elections matter? When you're not sure who is going to come, as the winner and what kind of policies they'll have, etc. I think definitely for the 2019 elections, the market just didn't care about it, right? The market had made up its mind that this is going to be the outcome. I think even now, I don't think the market is really having too many doubts, but it's not probably as sure as what it was in 2019. I mean, by and large, I would say elections should not matter unless there is a massive, swing away from what the market is expecting, for instance, right? So it'll be interesting to watch how the state results, come out, state election results come out. The only place where it would start making some relevance for the markets if the government's policies change, because let's say hypothetically they see some setbacks in the state elections, and hence in the run up to the general election they'll have to become more populist. And I think that's probably the only reason why the markets would care. But otherwise, I think it's not a big deal.
Let me just talk a bit about foreign fund flows, because you mentioned that there's been an outgo, at least in the last 2 months and a little more, as fears of increasing interest rate hikes recede to some extent in the US. Do you see some of those funds coming back? How do you look at India as a recipient of foreign funds vis-a-vis China? Can you sort of paint us a picture there?
So in general, emerging markets as an asset class should do well. Whenever funds are, whenever rates fall, in the US. I mean, that's what our work has shown. And you would see money coming towards emerging markets. If I just to put things in context for foreign flows into India this year, right? So I mentioned the last couple of years, 2021 and 22 were actually fairly weak in terms of foreign inflows. 23 has been positive. India has actually got one of the highest positive inflows. But if I remember right, it's about $12 billion year to date. After the sell-off that we saw over the last 1 month, about $5 to $5.5 billion can be attributed to one FII investing into one group of companies, right? And if you and that's money that doesn't automatically come back to the market, that goes into the promoters kitty, right? So in that context, it's been a normalized year for flows for India. Now, when you say flows do start coming back and start chasing into emerging markets, this is where I think the overarching. So when we talk to foreign investors, they're very curious about what's happening in the Indian markets, but there's also a very strong caveat that the market is looking really expensive. Are there still places within India where we can still find value? Right? Because as I told you earlier, I mean, for similar set of from a company basis, if I strip out the name of the country where each kind of company is listed, if you just look at the financials, you're getting far cheaper in other countries. But it's just that because it's an Indian stock, it's you're getting that premium. And I think that's kind of visible over the last 2 to 3 years in terms of how the foreign investor, foreign money has actually behaved. Right? So you generally net sold over a last 3-year basis. So there are opportunities, let's say in North Asia, where there is a revival possible in the tech cycle, and you can see a clearer link to company earnings from stuff like AI and stuff in North Asia, in, let's say, Korea, Taiwan tech space. I think versus China in particular, I think for a global fund, if it is if China is complicated for a while in terms of taking a strong call, generally that means you take money out of emerging markets, and that's what we've seen clearly when we look at global funds behavior. They don't take money just out of China; they take money out of entire emerging markets. They put it into the US, put it in Japan. That's what happens, right? So yeah, I mean, I think this year we've seen some positive flows into India and minor negative flows into China. I wouldn't be able to explain India is because China's seen outflows. So I don't think it works that way.
You're not making that correlation. But just to round off, you've talked about the India premium. You've talked about expensive valuations. Do you see that premium continuing, and do you see those valuations improving, or at some point investors will have to cough up and those the market stabilize in an upward direction? What's your sort of forward look?
I think the risk is more to the downside on valuations than than even staying. Forget about going up. I mean, I think look at it from the different investor classes perspective. If you're looking at a foreign investor, you would compare. You always do a comparative relative analysis. What are you getting here versus what are my other options? If you look at it from a domestic investor's perspective, of course, you're unlikely to be investing outside of India, so you're basically limited to investing within India. What are my fixed income instruments giving me? I mean, you are seeing decent yields and returns over there, and what is the kind of performance that the market itself is giving you, right? I mean, it's been pretty flattish for the last 2 years. There was a really sharp rally, in 2021. But then if I take a last 18 months, 20 months basis, Nifty has had ups and downs, but it's been pretty flattish, right? So then you start comparing. I mean, is the richness of valuation affecting and not allowing the market to go up further? I'm probably better off putting money in fixed income instruments. So I think US and India happen to be two unique markets at the moment where equities are extremely overpriced versus the local bonds. And I think in both these markets, it makes sense to look at fixed income rather than equities at the moment, right? Allow for some correction in equities, and then you can come back into equities.
Okay. Thank you so much, Sunil, for speaking with us today. And for that, I would say sobering insight to a time when, we're very excited about especially domestic investors coming in full form into the Indian markets, but exciting times ahead. Thanks again for joining us. And, while we wrap up this conversation, a quick teaser and reminder for you that we're not done talking to the UBS team. The India Economist, Tanvee Gupta Jain, is going to be joining me in just a few moments from now, so stay tuned. Welcome, you're watching BQ Prime. I'm Tamanna Inamdar, and on the sidelines of the UBS India conference, we're speaking today with the India Economist, Tanvee Gupta Jain. Tanvee, great to speak with you on the show in person here in Mumbai, and we've managed to pull you out of that conference. All right, let's first talk about and start off with the 2024 India Outlook report that you've just come out with. What is it looking like? Everyone is fairly gung-ho on India, the bright spot, relatively, etc. If you can just set the context first before we delve in on what is 2024 India economy looking like for you.
Absolutely, and thank you for hosting. If you look at our India's real GDP growth forecast for 2024 FY25, they're actually saying economy, despite the global headwinds, is going to continue to stabilize in terms of GDP growth. We have a forecast of 6.2% GDP for FY25, and this compares with our FY23 GDP growth of 6.3%. We have actually revised higher our GDP growth for the current financial year, and we do expect growth to continue to stabilize towards a long-term trend. Very interestingly, we also released a global outlook, and if I look at my global growth estimates, we are estimating global GDP to slow down by 50 basis points in 2024, largely because of weaker growth in the US and China. And despite this global headwind, I think India economy is doing well and the growth momentum will be holding up. If I look at the components, what will be driving India's growth in 2024, I think we would say that in a base case, we do expect consumption to normalize. We have seen consumption growth doing really well in 2023. But going forward, I would say a couple of things which will flatten your consumption growth or normalize it is one, the lagged impact of monetary tightening. We did see RBI has hiked the rates by almost 250 basis points. The second thing is we are expecting consumption-funded leverage growth or credit growth to actually flatten out. So bank credit, which has been holding up pretty well, we are estimating to stabilize around 13% next year. And third is this reopening tailwinds, and where we did see a consumption getting a lot of support from a very strong corporate revenue growth should also begin to normalize because we're already seeing the formal economy slowing down. We have seen the IT sector headcount reduction, which will impact the corporate revenue growth. However, I think on a positive side, I think the investment story will gradually become more broad-based. Government spending or push towards capex has been holding up capex story right now. But going into 2024, I would say the private corporate sector as well as residential housing activity should continue to remain supportive.
Okay. So, in fact, you've spoken about policy rates, and in another 4 weeks or so, you're going to hear from the Reserve Bank again. Your September inflation numbers for the lowest in 3 months, 5.02%. So two things. What are you expecting to see for the October data? Do you think inflation is now not as big a concern as was expected? And what is your outlook for the first cuts? We were talking earlier about maybe Jan, Feb, but that's getting pushed to June 24?
Sure. I think inflation data for the month of October, which is getting announced next week, should actually surprise on the downside. Our estimates are somewhere around 4.5% to 4.6%. However, I think maybe the worst of inflation is behind us. But one thing which I'm watching very closely right now is onion prices. The retail prices of onions have actually doubled. And when we were talking to a little more about agri journalists on the ground, we realized that the output for onions, because it is largely a winter crop, could be hitting the market only by March of next year, which means that we might see onion prices remaining elevated. That is something very important to note, especially with 5 state elections ongoing, because onion we have seen in the past really matter even for the political sentiment. Other than that, I would be closely watching the winter crop sowing, because we are seeing that the reservoir levels are lower than last year, and there was weather-related aberration for the summer crop. We are yet to see how the yield of summer crop has been, even though the sowing was almost flat versus last year. But we are already seeing sequential momentum building up, especially in cereals, pulses, etc. Plus, on top of that, you have the onion price increase, which we are seeing on the ground. So I would say there are upside risks to inflation for sure. We are maintaining a 5.5% CPI inflation forecast for the full year. Barring the month of October, where I do see significant correction, I would say between the months of November and March, my CPI inflation, headline CPI inflation would be in the 5 to 6% handle.
Okay. The other red flag for the Indian economy is crude prices. We have seen a whole host of geopolitical risks flare up, although they haven't translated to higher crude prices in the way that was expected. What is your outlook there on the crude impact, and has India managed to handle that bump well with, buying relatively cheaper crude from Russia, etc.?
So if I look at my global oil team forecast, we do see that there are more upside and downside to our oil forecast. We are expecting Brent at around $85 a barrel. When I look at the imported cost of Brent for India, and obviously taking into account the mark-to-market global crude oil prices, one interesting observation is that 40% of my oil demand has been met from Russia between April to August. That's a big number. It has actually gone up from 20-25%, which we saw in financial year 2023. And that is also one of the reasons that has helped in keeping the imported crude oil basket price for India contained. And I think that is also helping why your inflation momentum in the Indian economy is still holding up. From a rate cut point of view, I think that is also very interesting, because if the geopolitical tensions remain flared up for an extended period, I think it will be very difficult for RBI to go ahead and ease policy rates irrespective of what's happening in the global economy. So in our base case, we're expecting 50 basis point of easing in FY25, mostly in the September quarter as of now, because my global team, especially the US team, is estimating Fed to start cutting rates aggressively, like 275 basis point in 2024.
Okay.
From June. Yeah.
From June 2024, expecting Fed, so India may follow in September, in the September quarter.
Yeah.
Okay, so that, that timeline has been shifting consistently, and we're now at September. But I just want your take on the consumption story in India, a big sort of piece of the Indian economy. And one trend that is again and again echoing, whether it's in corporate results, sales numbers, is the divergence of consumption patterns. Luxury, discretionary items moving much faster than your lower end ones, that widening gap. How are you seeing that playing out?
So very valid question and very valid point. In fact, we have been highlighting that Indian economy is seeing K-shaped consumption recovery. So the urban affluent Indian consumption is holding up. We are seeing some slowdown in the rural consumption demand. So you can see that the divergence between rural demand versus the urban India demand, for example, whether I'm buying a two-wheeler versus I'm buying a passenger car sales, there is clear divergence. Plus, if I look at the consumption indicators, we realize that services consumption is doing very well versus goods consumption demand, and services is mostly consumed by the affluent Indian. So definitely there is a divergence. This is not to say that India was a very equitable society pre-pandemic. We always had that divergence, but yes, the divergence seems to have widened post the pandemic. In fact, we recently did a UBS Evidence Lab survey, and we called up these 1,500 affluent Indians. And we did the survey in August because we just get a gauge of how are they going to think about the festive season spending, which starts from mid of October, continues till December. And this is the third year where we are doing the survey. So I have data of what they were thinking in 21, 22, 23. And what I realized is that, one, the survey is largely focusing on affluent, basically rich and upper rich segment of the Indian population. And second, I realized is that 70% of our respondents in our survey are expecting their income levels to go up and festive season spending to actually go up. So largely what you realize is that urban consumption, especially affluent Indian consumption, is definitely holding up. And one reason why we are seeing the personal loan growth sustaining an 18% double-digit growth momentum is also because a lot of that consumption is actually getting leverage backed. And that is also one of the reasons why consumption
is that a concern, something the RBI spoke about recently, unsecured creditors? It's been a big theme, with banks as well. Just interesting to know your take on those growth numbers, and are there any concerns that you see there down the line?
As of now, if you look at the headline credit growth, it's around 15%. My banking analysts of the view it is going to gradually moderate towards 13%. For next year, we are still expecting headline credit, bank credit growth at 13%. The reason for moderation is we have seen, the working capital requirement needs of the banking sector is falling because WPI inflation, which is a gauge of input cost pressures is going down. We have seen a lot of SME lending has come down after the expiration of emergency credit guarantee scheme. However, if I look at the data, I would say our banking analyst is highlighting that there is a chance of NPL going up in unsecured lending, leading to higher credit cost pressure. Not a systemic risk at this point in time, but I think it is more to do with certain segments of the credit where I think there is a need to ponder and keep a very close watch on. So yes, definitely is something which is the biggest theme, and I think our banking analyst is already highlighting about that.
All right. Just as we wrap up, you talked about your outlook for 2024. What would you say are the major challenges or headwinds to look out for on your list? And are elections one of them at all?
So elections is definitely something, the most important market event, I would say, of 2024. I think we don't predict the election outcome, but based on any opinion poll or exit poll, I think most of the market participants are pricing Modi win in 2024. At least they're hinting that BJP-led NDA will be able to secure a good majority to be able to form the government. Yes, in case there is any negative surprises around that, which is, there could be a big market risk, because any kind of a coalition government will have an impact on policy stability as well as a reform momentum. I think from a global point of view, we are highlighting one upside and two downside risks. I think the upside could be, what about US does not see a recession and US economy remains stronger, like the way we have seen the US economy has been resilient in 2023. And I think in that case, I do see India's GDP growth surprising on an upside by almost 20 basis points. So instead of 6.2% GDP growth for FY25, my growth number could be closer to 6.4, 6.5. The downside scenario, on the other hand, I would say the sticky inflation scenario. What if inflation remains 100 basis points higher than our baseline? And that can lead to more monetary tightening globally. And that can have a lagged impact on my domestic growth weakness. So that is, I would say, the worst or the most downside risk at the moment. And somewhere in the middle is something about China, because my global team is estimating China's economy to slow down from 5.2% in 2023 to 4.4% in 2024. What if China economy slows more than what we are estimating in our base case? I think that can, even though India is not directly getting impacted because of slowdown in G2 or G3 GDP growth, India is not immune. So I would say some downside to India's GDP growth by 20-30 basis points is possible in that scenario.
All right. Thank you for such a comprehensive look at where the Indian economy is heading next year, which largely looks positive, with some perhaps challenges on the horizon. Thank you so much, Tanvee, for speaking with us. Thank you.
I wanted to wish all the viewers of BQ Prime and the channel a very happy festivities and a very happy Diwali. Happy investing.